Hi, today we are going to learn about settlement. Settlement of securities is a business process whereby securities or interests in securities are delivered, usually against, in simultaneous exchange for payment of money to fulfill contractual obligations, such as those arising under securities trades. In the United States, the settlement date for marketable stocks is usually 2 business days or T+2 after the trade is executed, and for listed options and government securities it is usually 1 day after the execution. In Europe, settlement date has also been adopted as 2 business days settlement cycles T+2. As part of performance on the delivery obligations entailed by the trade, settlement involves the delivery of securities and the corresponding payment. A number of risks arise for the parties during the settlement interval, which are managed by the process of clearing, which follows trading and precedes settlement. Clearing involves modifying those contractual obligations so as to facilitate settlement, often by netting and novation. Settlement involves the delivery of securities from one party to another. Delivery usually takes place against payment known as delivery versus payment, but some deliveries are made without a corresponding payment, sometimes referred to as a free delivery, free of payment or FOP delivery, or in the United States, delivery versus free. Examples of a delivery without payment are the delivery of securities collateral against a loan of securities, and a delivery made pursuant to a margin call. Prior to modern financial market technologies and methods such as depositories and securities held in electronic form, securities settlement involved the physical movement of paper instruments or certificates and transfer forms. Payment was usually made by paper check upon receipt by the registrar or transfer agent of properly negotiated certificates and other requisite documents. Physical settlement securities still exist in modern markets today, mostly for private, restricted or unregistered securities as opposed to those of publicly exchange-traded securities. However, payment of money today is typically made via electronic funds transfer. Physical paper settlement involves higher risks, inasmuch as paper instruments, certificates, and transfer forms are subject to risks electronic media are not, such as loss, theft, clerical errors, and forgery. See indirect holding system. The electronic settlement system came about largely as a result of clearance and settlement systems in the world's securities markets, a major report in 1989 by the Washington-based think tank, the Group of 30. This report made 9 recommendations with a view to achieving more efficient settlement. This was followed up in 2003 with a report, Clearing and Settlement, a Plan of Action, with 20 recommendations. In an electronic settlement system, electronic settlement takes place between participants. If a non-participant wishes to settle its interests, it must do so through a participant acting as a custodian. The interests of participants are recorded by credit entries in securities accounts maintained in their names by the operator of the system. It permits both quick and efficient settlement by removing the need for paperwork, and the simultaneous delivery of securities with the payment of a corresponding cash sum called delivery versus payment, or DVP, in the agreed-upon currency. Thanks.